right, y'all. We're gonna go ahead and get started. Um, I feel like I just watched the clock from 9:02 to 9:03, and I don't think that minute has ever lasted longer in my life. So, hello, welcome. I feel like I've got the whole new agent crew here this morning. I'm like, yes, I love that you guys all showed up. Thanks for coming. Austin, I'm gonna need a little bit of background info on what's happening in your life right now. Are you in the middle of a workout? You're outside? You're muted. So
I ran a little bit further than I thought. So here I am at Starbucks.
that's incredible. I'm so glad you got stranded on your run, but you decided to show up for training anyway. That is true dedication, ladies and gentlemen. Okay, perfect. Well, thanks for coming. Today we are joined by Larry Nutt, expert mortgage broker and good friend of mine. I'm so glad he's here this morning. Before we get kicked off, I wanted to remind you of the other two sessions we have this week. So tomorrow, Michelle and I are actually leading a training. So a rare instance where I get to actually lead a training. It's on technology and organization. So we'll be going through kind of a brief rundown of all of our technology, and I'll be giving you some tips and tricks on like, hey, these are like different ways that you can use this technology or ways that I've found that is helpful. So hopefully you can make it to that. And then Thursday, remember that that's an in-person session. We'll be meeting in the BottleWorks office. Crystal's leading it, and it's on buyers and everything you need to know about them. So make sure you come for that. And I'll get into the schedule for next week later. But glad you're here. Without further ado, I am going to turn it over to Mr. Larry Nutt. Thanks for coming. Larry, before you kind of launch into mortgage stuff, can you just tell us more about who you are and how you got into the business and where you live and all that good stuff?
Yes, so I actually have a slide for that.
You do? What a
I
treat.
do have a slide for that.
Okay.
So let me share this here. So first off, thank you everyone. This is a lovely photo of Meridian Kessler that my photographer took. So obviously we're Indianapolis focused kind of thing. And I'll get into everything now, but about me. So a few things about me. So I think you asked me how I got started in this, right? So I graduated from Huntington University. I'm from Central Indiana. And I got a job as a part-time teller while I was in college, and then became a head teller and then a branch manager, et cetera, over time, and then eventually worked my way into lending about 6 years ago for a bank, and then kind of did that for a while, and then transitioned about 2.5 years ago to where I'm at today. So kind of fell into, I guess, the lending role, if you will, and now I'm never going to leave. So things about me: I love strong coffee. I'm actually a big fan of Calvin Fletcher. I have the little mug that I go and get Calvin Fletcher every morning, kind of my thing. Obviously closing loans. I have a mullet. My marketing guy put that in there. He made me leave it in there.
Yeah, no, we're not going to let you just glaze over your mullet. I want everyone to know the full story. How did the mullet start? Why is it still with you? How long have you had it? We need the full details.
I think I did it to, I don't remember exactly why I started growing a mullet in the first place. I've always kind of been obsessed with mullets, even since I'm in high school. And it just, I was like, oh, I guess I'll just grow a mullet. And then here we are. And now apparently it's like relevant to have a mullet, which I feel weird about that I have one now. So yeah, my fiance does not like it. And it's fine. I mean, my marketing
Well, now
team
it's essential to your marketing. Like people know you
I've
as the
pigeonholed
mullet
myself.
guy.
Yeah, I've pigeonholed
Yeah,
myself.
you can't ever get rid of it.
Conan O'Brien with his hair, right? Like he could never cut his hair. I'm kind of stuck. So my own design. I love memes and music. I kind of like indie music. I saw Ron Gallo at Hi-Fi Annex on Friday. I'm kind of into that, into alt country scene, like I don't know, like Nick Shoulders and stuff like that. So anything else you want to know about me? Oh, one thing, I am sorry, I have my bike in back. I'm painting the room behind me. And so everything that's in that room is in like every other room in the house right now. So I currently live in Fletcher Place as well, so downtown.
That was the only other thing I wanted you to say is where you lived. So it's perfect.
All right. So kind of the first part of this, and this may be pretty basic for some of you, maybe a little new to some of you. I'm going to go through the process from kind of like when I get a referral or a client to getting them under contract and what that looks like, kind of a timeline standpoint. So you're initially, however the client gets to me, whether it's from my own sphere, whether it's from an agent referral, whether I just meet them, randomly or whatever, we'll have an initial conversation, a consultation. It's like a 15-minute phone call, kind of to get an idea for me is, does it make sense for this client to apply? Is there, because we're going to pull credit as soon as that application comes in, and that's an impact on their credit score. If they're not buying for 2 years, then maybe it doesn't make sense to pull that credit. Maybe it does. We can't solve problems unless we know they exist. So that's kind of the catch-22 to that. I kind of drive them to apply so I can kind of see, and then we can solve if they've got a credit issue or whatever. So once we have the initial consultation, they create a loan application. And in that loan application is when I will, like I said, pull credit. Pull credit, review an employment history, income, assets, determine the home buyer's qualification. What that means is they may or may not have sent their income docs and financial docs with them. But so the application comes in, it's whatever they said. So they said they work 80 hours a week at, $25 an hour. They said they have $20,000 in their checking and savings account, that kind of information. And so we can kind of get an idea of what that is, but really it doesn't tell us the full picture. It's their perspective on what they have, right? So once I kind of see that, I pull credit and look at that basic history. I'm going to look at loan programs that make sense for them. So if I know instantly, like if someone says they have $5,000 and they're looking to buy a $200,000 house, we're already going to be going down a path on a certain loan program versus another. And I'll get into loan programs in more detail later. But does this all make sense? Is there any questions so far? And if you have questions too, like this is very like casual, you can just pop in and say something if you have a question on this stuff. It's not a big deal. So the next step here is the pre-qualification letter, file processing, and validating assets, right? So the pre-qualification letter is basically, I mentioned earlier, the client has applied, they have entered their information. I've looked at loan programs that fit the information that they've provided. They're technically pre-qualified. There's a difference between pre-qualification and pre-approval. Pre-qualification means that they have just sent their information into me. I have not verified it other than their credit report and credit score, and they are qualified based on that information. I don't use pre-qualification letters because I haven't verified the things they've said. So we don't know if they've been on the job for 2 years or if they are, they don't make any money. We don't know this scenario behind their income. And so if you're writing offers on pre-qualification letters, that person may not actually be able to get that mortgage because it's not actually the truth of what's happening. So once that pre-qualification letter comes in, I kind of set up in this file processing kind of thing internally for me. So that's kind of where I'm kind of asking, this is when I ask for these asset stuff, these next 2 steps. So I'm going to ask the client, we'll have a conversation after I've kind of done this pre-qualification letter. That's when we set up a longer call. It's like an hour long. And I go over everything. We talk about scenarios. By then they've sent me in their income docs and stuff, and we're kind of getting that and putting that together. That may not happen all at once. Sometimes people piecemeal them in. Sometimes I get them all at once. But that's kind of where we're processing stuff and validating assets. We're making sure that the income is legit. I have pay stubs to support what they're saying they're getting paid, or if they're self-employed, I've done the income calculation. I've looked at their tax returns and their year-to-date profit and loss statement and analyze all that. And then assets, I've got their checking account, their savings account, their Robinhood account statement, whatever they're using for their funds. I have seen tangible proof that they exist, right? And then that's when we are technically pre-approved. That's when I would send the pre-approval letter to them. on a basis of whatever the price they want, right? We kind of talk about what the ratio should be, and and we'll get into that in a minute too. But depending on where they qualify, say they have a budget of $250,000. Well, here's a generic letter for a to be determined address for $250,000, right? Now the next unlimited pre-approvals, if you've been in the market for any time, you know that unlimited pre-approvals is important because we're writing multiple offers, right? So this is when things get fine-tuned for the pre-approval letter. So like we're going to send a TBD one, right, for this first one for generic ad price, but say they really like 123 Smith Street listed at 221.5. They're going to write an offer with an escalation clause up to 230. So I'm going to send a letter. You or the client would reach out to me. I send you a letter for that specific address. And generally I will call the list agent as well. And if there's multiple offers and like, hey, my name's Larry, this client's pre-approved, yada, yada, yada. And so then that's a specific to them. They don't get the property. We just repeat the process as many times as we need to. If we need to update income and assets, we do so. If, credit reports are good for 4 months from when I pull them. I pull the TransUnion, Equifax, and Experian, all 3 bureaus. And so that's good for 4 months. So if we get to the end of that 4 months, then I need to get things updated. So that's when I would request like, hey, I need updated, I need everything new again. You don't have to fill a new application out, but I still need that new documentation before I repull this credit. And generally we'd have a conversation of that, like, are you continuing to look? Because if you're not, I'm not going to pull your credit because it doesn't make sense. But if you are, then we should do this. And that way they're ready to go still too. So we're kind of making sure that they're just sitting in this queue ready to go when they want to write an offer, especially in this market when it's like new listings come out on Thursday, highest and best by Sunday. You need to make sure you're in line, ready to go, right? So when you finally get an accepted contract, final underwriting, this phase, I could teach an entire 4-hour class on. So accepted contract to final underwriting. Basically, once I have an accepted contract from a client, then I can lock the interest rate because I have the address. We will run underwriting specific to that property. And in some scenarios, we can get an appraisal waiver. Some it depends on the property and the client. Then it gets kicked into processing. My actual processors, Missy and Jasmine, would touch it then. And now every lender is different, of course. This is kind of a vague assumption. Most of us operate in a similar manner, but then they would kind of review the file that I put together. So if I pre-approved a client on, what's today, the 18th of May, if their initial application was done on the 1st of April, and I had updated bank statements and pay stubs as of April 1st, then obviously some time has passed. There's a full April bank statement that exists now, and there's 2 pay stubs at least that we do not have. So my processor would request that updated because the underwriter is going to want to see a 30-day snapshot of their income. They're going to want to see 2 months of bank statements, most recent bank statements, and in some cases a month-to-date transaction summary. It depends on the circumstances. And then once that's done, it gets kicked to underwriting. They will they'll look at the thing. They usually will issue what's called a conditional approval. A conditional approval means that there is just outstanding conditions, and they're usually not a big deal. Like we need updated title docs. The appraisal needs to be completed. We need to get a verification of employment. That's the bigger thing, especially with COVID. It's a little different now, but in the middle of COVID, we were having trouble talking to someone in HR because everyone was working from home and we have no way to get hold of people, which doesn't sound like a big deal. But when we need a verbal verification that the client is still working where they're working 48 hours before close, we can't get a hold of anyone, it can potentially delay a closing. So there's a way we have a form that we have clients fill out that has their supervisor and their HR manager phone number, so we can call them if needed. But so that those are always conditions that are outstanding. And then we clear those up one at a time, and then we get the approval. And then if there's mortgage insurance, we order that. That takes about 24 to 48 hours. And then that's the clear to close. And then we're balancing the title and you're closing. It can take, like I put 30 days on here. That's the industry standard. Some scenarios I have a closing right now that's not closing until July 30th. I've got one that I just got a contract for yesterday that's closing on the, the like first week of June. So you can do things pretty quick. It's never a blanket statement though, because it depends on the client, depends on if they're self-employed or they have all their ducks in a row. If when I get the file, everything's updated and good to go, then we can close in about, 18 days if necessary. It's not ideal, but that can happen. So what kind of questions do you have? I kind of went over all that information quickly, and I can get you a form of this, Rosie. It's like, I mentioned earlier with Tanya, we have a client who I sent them this version, but it's like a PDF, and it has everything on one page. I can send that to you. But what kind of questions do you guys have so far?
Larry, did you say how long a pre-approval lasts?
Yeah, so as long as the credit is valid. So
Okay.
technically 4 months. Now, I mean, if we turn around and reapprove them, they're still pre-approved, right? And so, but yeah, 4 months, unless something, that pre-approval letter, let's be honest, is a handshake. Whether it's pre-qualification letter, whether it's pre-approval letter, whether the client is under contract, it is a snapshot in time that says this client is approved. None of us can control if they go out and they get fired, they quit their job, they spend all their money on something. We don't know that until we know it, right? Like, and so it's kind of an agreement, and I will go over, the next slide actually talks about that, but it's kind of an agreement between all of us and the client that like, hey, you are not changing things. And if you are changing things, it's just, you have money coming in, you're living your life as you've lived it. That's what I always tell everyone, like, don't change the way you're doing your life unless I tell you to. Yeah, it's about 4 months. So.
Perfect. Another question that came to mind, I know, there's a whole list of like, don't do this, don't do this, don't do this. I've never seen like going on vacation on there. Is going on vacation can that be a bad thing for when you're about to buy a house?
Yeah. I mean, it's some things we can't control, right? Like as you get, I'm sure I don't know where everyone on this call is at in their career, but if you want to get busy in our industry,
most people on this call are like just a couple months in.
Okay, that's good to know. I always say, like, if I want to get busy, I'm going to schedule a vacation personally, and then nothing will happen. And then as soon as I leave, everything blows up. That's the way it always works. So the same is true for your buyers. They may be looking for a house for months and they planned a trip, a long time ago. And of course, that's when the house they like comes up. If it's not impossible, it doesn't, like I have one, for example, things that come up that you don't really realize. Europe. Everything that we do in our industry is electronically disclosed. So when I get an accepted contract, I send out the disclosures electronically. They can sign it on their phone. Great, easy peasy. They can do it wherever they want. There is problems though with IP addresses in Europe that can present issues, or they may not be able to access the things. They have to go to a computer lab somewhere and sign these disclosures, and there's issues with that. Just things to think about. Now we can't control, there's ways around it. We would just work through it, right? Figure out a way to work through it. But it's not the end of the world. As long as you can access the internet in a secure manner, wherever you're at, then that kind of solves some of the, now from a closing standpoint, they do have to physically sign something, whether it's a power of attorney to have them legally sign for a closing, or it's the actual closing itself, which can be done remotely. It just costs a little bit, depending on the title company. You can work through most of those issues, but definitely not ideal.
Yeah, that makes sense. Larry, we just had a question come in from Lisa on the chat. She said, can you talk about unemployment because of the coronavirus and approval? How many do not qualify for loans because of that?
Quite a few. So unemployment specifically, let's talk an industry that you would never think would have an issue, dentistry. I had a dentist who was approved, who was a self-employed, owned his own practice. made a great amount of money. He was technically approved, just not for the price that he wanted. So in scenarios like that, you average income over a period of time. So it could be 1 year, it could be 2 years, depending on the circumstances, and then year to date. In someone that is self-employed, you're going to do a snapshot. If it's 2 years, then we're going to average it over 2 years plus the months to date. So in this case, we're talking what, 29 months over a 2-year period of time. If 3 of those months they were off for COVID, they have zero money coming in, that drops the average monthly over that period of time significantly. And so he couldn't qualify for the house that he wanted. And there was no way around that. It was just, that's the way it is. Like, unfortunately, we can't use unemployment income. We can't, that coming in stimulus stuff, we can't use that as qualifiable income because we need to show a history of things. If it's someone who maybe isn't as high level, maybe was in the serving industry or something like that, there's no wither way around it. And it's going to take some time for us, because the average of them not making any money during the initial shutdown, which was 3 or 4 months, that average is still there, unless they're in a job that is salaried or hourly, that they get 80 hours a week, with the only exception is the period of COVID and they were furloughed. That's okay. If we can cover, we can work around that. But if they were variable income, whether it's tip or commission, that average is going to be there. Because one thing that we do for anyone who has a variable income, whether it's someone in sales, someone like us in this chat, someone as a server, you average that income. I look at the year, if they're getting pay stubs, we're looking at the year-to-date income. We're looking at the year-to-date income from the end of 2020 and the year-to-date income of 2019, and then we're going to average it over that period of time. And that's the only way we can determine the history. If income is declining, so say hypothetically in this same case, that person made $115,000 in 2019. In 2020, due to COVID, they made 85. 2019 does not exist in this case. So now we only average from January of 2020 to May of 2021, and that's the income we can use. Like I said, there's always exceptions to those, but that's the general rule for that. So let's get on to this next here. So terms to know, we kind of talked a little about these so far. So these are, you may have seen these. You guys, if you bought a house, you may know these. I don't know if they cover any of this stuff in the licensing course. Probably not. So APR is just annual cost of the loan. So it includes interest, discount points, fees, insurance in a percentage form. So if the rate is 3%, APR may be 3.25 or 3.276194, right? Or something like that. It's never going to be lower than the actual interest rate. The actual interest rate is how much the client is paying for, they're borrowing $200,000 at 3% for 360 months. That's the interest rate. That's how much interest is generating. That's the calculation. But APR is put in the actual cost of obtaining a loan and maintaining it. Appraisals, appraisals is a hot thing, especially right now, right? And in here is, obviously it's an estimate by a professional of the value of property. That's the vaguest statement that I could put in here because it's exactly true. It does not determine whether someone's getting a good deal. An appraisal is just a professional's opinion based on data that they can pull to support the value of a property. And that's it. And so, I'm sure you've all, I don't know if you've seen it, Rosie, but there was an article recently about the home in the Flanner House neighborhood about the appraisal that came in short, and there's a race component to it, that sort of thing. There's a lot that can go in, the appraisal stuff is not binary, like everything in our world. There's a full spectrum of stuff. So the one thing that usually the number one cause to appraisals coming in low is comps. There's not enough data in the neighborhood market to support the value of the purchase price. And we can't, and then there's qualifiers that you can do. So like the appraiser will look and say, the house we're buying is a single family home, 3 bedrooms, unfinished basement, which is worth X. The comps in the neighborhood are all 3-bedroom houses with a finished basement, and that means they're worth this. And so they will tweak and change things and adjust things based on that information, and that's how they determine the value. And it's only as good as the data that's out there. In a market where values are increasing rapidly, that can be an issue, especially in some neighborhoods in our community. Like I'm thinking like Irvington is a prime example, and Emerson Heights, right? There's technically, Emerson Heights is not Irvington, but you can use comps from, if you're in Emerson, you really can't use comps from Irvington because they are slightly different. And I run into that issue all the time. And just make sure that, as an agent, that you know exactly, and you can tell your client exactly, and you're using comps exactly from the area that is just. Now, if a value comes in low, you can just, there's a rebuttal process that we go through before it even hits anyone's hands, before you or the client knows the appraisals came in low. We've already scrubbed it. We've looked through everything. Okay, yes, this appraiser is right based on the information that they've put together and that we're seeing out there. Then we kick it to everyone, and then the buyer or seller and or both can go out there, look for additional comps, or ask to remove certain comps and get a new value assumption. If we still have an issue, there's a, you can do a desk review, which is basically a desk appraisal. And if that comes in low, then you can still do another appraisal with an independent appraiser to go out there and value the home. If all that comes in, they're going to use the lowest value of all those things. Then that's what the value is. But there's an exhaustive process that you can go through as well. We can get into that. I'm sure we'll have questions on that. We can get into that in a minute. Debt to income ratio, we've kind of already covered this. Monthly gross income over the liabilities that show up on the borrower's credit report, and including the projected housing payment for the house they're buying. So there's a front end ratio and a back end ratio. The front end is just the gross income and the liabilities they have on their credit report. The back end is the same thing. You're just adding in the proposed housing payment for the DTI. And based on the DTI, that's how we qualify someone from a monthly standpoint for a loan. Escrow, when I say escrow, I'm referring to taxes and insurance, flood insurance on a monthly obligation. Clients do not have to escrow. They can choose not to. The only time I recommend doing so is when you are buying $1 million house and the taxes are $15,000 a year. Escrow accounts are non-interest bearing by law. It's money that just sits there, does not grow, technically it loses value because of inflation. So when you're a wealthier client, you would elect to not use escrow at the cost of, it's generally about 1/8% higher on your interest rate. So if you were at 3% with escrows, without, you're probably 3.125. But that is worth it to some people when they have high taxes, and that sort of thing. Loan to value is the amount borrowed relative to the value of the property. The value of the property is one of two things, back to appraisal: the appraisal price or the purchase price, whichever is less. So in this market, we have gap coverage is very common, the gap verbiage. So meaning that the client is going to make up the difference if it under appraises a dollar amount, right? So it's like we're writing a $350 offer. Our client's going to cover $15,000 if it under appraises. If it appraises at $335, in our eyes, that's the value of the home. Anything after that, the client's paying. So the loan to value is based on that appraisal. In the event appraisal comes in higher than the purchase price, it's still going to be the purchase price, whichever is less, is what we're basing the value on. And then PMI, private mortgage insurance, kind of, you heard it called different things. It's a fee paid on monthly mortgages it varies depending on the loan program. If you're putting less than 20% down, it's going to be there. For conventional loans, for FHA loans, it's a different structure. But basically, it's a monthly fee that protects the lender and the servicer in case of default. You know, it hasn't always existed. It's a good thing. People get upset about it sometimes, but without PMI, 20% mortgages, 20% down mortgages would be the only option. So it's kind of a good thing from that standpoint. In a conventional world, it's driven off your credit score and your loan to value. It's tiered, so like 3%, 5%, 10%, 20, 15%, 20% down. That's the tiers. So if you had like a 680 credit score and you're only putting 5% down, your mortgage insurance on a conventional loan would be significantly higher than it would be if that same client was putting 15% down instead. And that's kind of it's a whole, you could have a whole conversation about that as well. What kind of questions do you have on these terms so far? Good. Golden. Okay. So we talked about loan programs here. And this is going to be a very high level view of loan programs. There are a number of programs that I probably won't talk about, not because they don't exist, just because for the basis of time, we can't really get into them. And we can kind of talk, if you have individual questions on each one of these, let me know. But obviously FHA loans, you've heard of this probably, it's a government loan product. Good, I mean, it's good for first-time home buyers or anyone who has adverse credit, meaning adverse credit would be like under 700, 680 or less would be ideal. These clients in the before COVID, you could go down to 580, and some lenders probably will allow you to go to 580. We used to do that. We only go to 620 now. I can tell you from experience that if you're below 620, even if you're allowed to go down to a 580 credit score, it's very difficult to find someone who can do that. Because odds are the reason that they're at a 580 is due to a collection account of some sort that may or may not be medical. If it's not medical, that collection account has to be paid before you close. So then you're asking a client who has a 590 credit score to pay their $1,000 collection account in addition to 3.5% down plus closing costs. You know, they would have paid that off if they had the money. And so it's unfortunate, and that's not always the case. There's exceptions to that, of course, but that's kind of what I've seen. The seller can pay, so 3.5% down is the minimum down. There are some state programs that you can pair with an FHA loan, but odds are there's better options for a client than the state programs, especially if they're in this kind of credit window. You can, avoid that. 6% up of closing cost. So that is tiered though. If they're putting less than 10% down, they can only get 3% of closing costs. So they're putting more than 10% down on an FHA loan, they can get 6%. That closing cost though cannot exceed the cost to obtain the loan. So closing cost and the escrows, prepaids is what they're called, is less than 6%, then your client's leaving money on the table. There's ways that we can structure it from a lending perspective to try to help. We could have them buy down their interest rate a little bit and charge them discount points for the rate that can maybe absorb some of that if they got full 6%. Obviously, this conversation is kind of, you probably forget it by the time you need to do this because we're not in a market in which it supports people paying closing costs for the buyer. But when you are in a buyer's market, that's more common. What I see that question come up the most is inspection response stuff. So you've got under contract on a house and they weren't paying any closing costs before. And now there's a bunch of stuff that comes up in the inspection. You're going to ask for one of two things: the client to fix, the seller to fix the things, or they're going to give you a credit for stuff, right? That credit falls in this category. It cannot exceed the closing cost. So it's a $10,000 repair, but the loan is a $125,000 loan. The closing costs are not going to be $10,000. So we've got an issue. That's when we kind of step in and we can chat about that. Also, people know scores are allowed. It's always better to have some kind of score if possible. If you have two applicants, we're going to use the middle lowest score of the two. So if one client has no score, the other one has a score, that helps, but we still are going to base it on the no score program. So that's kind of a 40,000 foot view of FHA. What kind of questions do you have now?
Larry, I guess I'm just curious, like, do you see a lot of FHA applications coming in these days? I feel like it's just really hard to make FHA work in this market.
I would say year to date, I've not done a single FHA loan. Last year, I did 2. Now, part of that is the market that I work in as well, right? Like I've primarily seen things in English. But yeah, I mean, it's pretty rare. There are still people out there. There's a loan officer in my group that has a number of FHA loans. Now, her clientele is buying in like random small towns in rural Indiana. So in the hierarchy of accepted offers, right, you've got cash, conventional, insured conventional, FHA, VA, and then USDA would be last. So if you're in a rural market, FHA is better than USDA. So that's where you're going to get those things. But I would say it's pretty uncommon. There are always exceptions. The two that I think I said the 2 that I did last year were refinances. Actually, they weren't purchases, which is different than that as well. But it's hard to get in that. You have to have a pretty sweet offer. One strategy I have seen that works, or that, I mean, case by case basis, there's no stipulation on how much money someone can put down up front, with the exception. Basically, your earnest money can't exceed your down payment. So 3.5% in this case. And people are putting earnest money of like 3.5% down on an FHA loan, which is, I don't like. It's very risky because you're in a transaction. If there's a mutual release, you may not be able to get that money back, and that's 3.5% down. That could be a lot of money for someone in certain scenarios, especially if we're on FHA. But yeah, it's pretty rare, I would say, to get an FHA offer accepted. That's why we talk about those state programs too. Like, that's great, they exist, but you can't use them anyway because the seller is not willing to accept an FHA loan in the first place. Any other questions? Okay. So USDA loans, I will breeze through this one because I'm assuming that most of you are like me, that I always make the joke I can't spell USDA. I've done USDA loans, but I live in Indianapolis. While I'm in front of a rural community, there's not a single spot in Marion County that would qualify for this. You're talking, Fortville, McCordsville, Brownsburg, Avon, maybe a little farther out there. They're great loans for rural properties for the right person in the right scenario. They take a long time to close due to government oversight. We get the file ready, we approve it, but then it goes to the government. They have to review it. Sometimes that turn is a 30-day turn time. Sometimes it's 45 or 60. So if it takes us 15 days to get it ready for that, you're at a 65, 75, 90-day window. Hard to find sellers that are going to do that. There's also restrictions on properties as far as like outbuildings, what's plowable, if there's plowable land, if there's pasture land, if there's a barn, is that barn going to be used for commercial income generating purposes? Very nuanced, but just know it exists in a different market, different conversation, but the market is the same way it is here. It's everywhere, which is why people are using FHA loans more often than USDA. Any questions on those? I would guess not, but okay. Conventional loans. This is probably, I mean, it's 97% of what I do is conventional lending. So real quick, minimum credit score is 620. Minimum down payment is 3%. In some cases, it's 5%, depends on the client. Seller paid closing costs can pay up to 9% of the closing costs. Same rule, closing costs can't exceed the cost to obtain a loan. They can only, and this is, I put a little asterisk here, this is tiered again. So less than 10% down is 3% max closing cost. So after 10% to 24.99% down, the buyer can receive 6% of closing cost. More than 25% down, they can receive 9% of closing cost. Very rare that it happens, only in exception scenarios that I've seen. And then there's different mortgage insurance options, single split, lender paid, borrower paid. The most common is borrower paid mortgage insurance. That's what everyone wants to do typically. Because so with these single and split scenarios means you're paying a lump sum for the mortgage insurance. That's like, okay, we know if you're buying a house, putting 5% down and it's valued here, if you make, if you make the minimum payments, that's going to be a dollar number over, 10 years, how much you're going to pay. You can pay that all up front. The reason I don't like it is because if you decide to refinance or sell your house before you get to that period of time, you wasted money by paying your mortgage insurance off too soon. And if you're even having that conversation, it means you probably have a good credit score. Mortgage insurance is probably not going to be that much. A good example, I've got a client who's buying a $450,000 house. They've got an 800 credit score, putting 10% down, and the mortgage insurance is like $103 a month. If they had a 700 credit score, their mortgage insurance is probably $190. So but it's still in the value of the home in the grand scheme of things, it's not a lot of money. It is money, but it's not a lot of money. So yeah, borrower pay would be the most common. I would say 95%, if I had to put a number on it, do the borrower paid mortgage insurance.
Larry, what's the difference between the 3 and the 5% on a conventional loan? What causes that? Is that income or credit score? Or?
Yes, income for sure. There's credit score stuff too. So there's home ready and home possible. So there's Freddie and Fannie, Freddie Mac, Fannie Mae. That's the two conventional company, bodies. They're government sponsored enterprises, the GSEs. But so they have two programs. One, Freddie's is home possible, and Fannie's is home ready. If a client makes 80% LMI of the area, so the area median income, then they could qualify, which is like $68,000 as a household, or not a household, as a borrower. If you have two borrowers, they both have to be combined below $68,000 for our market. If you've got one, then that person needs to make less than $68,000 and be a first-time home buyer. If they make more than $68,000, they have to put 5% down in most cases. They can still put 3% down, but if they make more than that money, their interest rate is going to be so much higher at 3%, they need to do 5%. There's also a home one program, basically, and it is the 3% down rule has no cap on income, which is beneficial to like suburb areas, because if you're buying in the suburbs, you're buying a higher value house, means you make more money because you can afford that house. You can go to 3%. That the problem with that is you don't get a lot of the benefits to the home ready or home possible. Why home ready and home possible are nice, because it not only does it allow you to go 97%, but it also discounts your interest rate due to loan to value, and it discounts your mortgage insurance. Even if you had a poor credit score, so you had a 690 credit score, if you were doing a normal conventional loan, your mortgage insurance and interest rate are going to be way high. If you can do a home ready or home possible loan, your interest rate is going to be what we talk about interest rates being, right? Like you're talking 0.5% difference. So yeah, income and status of home buyer, and it just has to be one person on a loan that's a first-time home buyer. And the definition of a first-time home buyer is someone who's not owned a home in 3 years, but not been on a mortgage in 3 years. We don't care about title stuff. So what kind of, I kind of talked about FHA and conventional. The reason, I guess, does anyone have questions on why conventional is better from a seller standpoint? Because if not, so appraisal quality is the reason for it. The subject property that you're appraising. Not to say that conventional would never have issues with an appraisal, because they do. I had one just recently, Irvington, there was no handrail to go down the basement stairs. Needed a handrail. For conventional loan, needs a handrail. I mean, it's 4 steps, anything more than 4 steps needs to have a handrail. It's a health and safety issue. So conventional loan would have that requirement. FHA loan may have had the stair loan or the handrail, but also the windows are peeling. The downspout was dented by a mower. That needs replaced. The windows need painted. The siding is peeling, or there's a structure. It could be as large as, hey, the basement wall is caving in. You know, like it could be. And so that's why people like conventional versus FHA and whatnot. There's no, someone can put 50 to 60% down on a conventional loan. Any of these loans they could. If they're putting that much money down, they're probably doing conventional. As long as they have the money, they can do kind of whatever they want. Oh, so there's conforming and jumbo conventional loans. Conforming goes up to 5. It goes up every year. So right now it's 548, 250. So if you have a person who's buying a house and their loan is going to be greater than $548,250, then it's going to be a jumbo loan, which is a whole different ballgame. If it's below that, then it can be exactly 548, 250. I've got clients who will buy a $700,000 house and pay exactly to 548, 250 so they can be a conventional loan, because there's big implications on rate and structure of the loan offer as well. You can also partner these conventional loans with state programs as well. It's less likely because the problem with every down payment assistance program is timing. And in a market in which things are quick and fast, you need to be quick and fast. And so there's like HOP funds is one thing. There's a number of other first-time home buyer programs that you can get like a 3% grant, or it may be a form of a grant that's actually a lien on the property that is paid off, that will expire after 5 years. The problem with that is most lenders don't like that because it's a lien on the property. But you can do those things all exist without getting too off in the weeds in them. You still have to get someone under contract to get those. And with HOP funds, it's HOP. Don't ask me, the home ownership program, I think is the acronym. They run out. It's a state allocation. It's a federal allocation to states. That's a bucket of dollar. It's like, okay, here's $4 million that you can use for HOP funds until it runs out. Well, it's July or it's May. They usually run out in July. So you've got someone, and every year's different. But if someone's banking on those HOP funds, they could be gone by the time, because you can't apply for them until you're approved on a mortgage, which means you're under contract and we've done enough due diligence to get you approved. Then you can apply for the HOP funds to get the grant, but by then it might be gone. And then you're still dealing with the issue of like, that means that client's putting 3% down to get under contract on a house might be difficult for that scenario. Any other questions? VA loans, I'll kind of breeze through these real quick. 100% financing depends on the circumstances of the VA. We order like a certificate of eligibility, a DD 214, to make sure if they are discharged, they were honorably discharged, etc. Minimum credit score is 600. There's no monthly mortgage insurance. That's the appeal to these guys. They do have the added hurdle. There is a VA funding fee that's charged that's added onto the loan, and there's some additional stipulations for sellers. But VA loans are they're a good option. Once again, it's unless you're cash or conventional, it's hard to get under contract, but they do exist. Where we could talk on about 4 hours on a VA loan as well. Do's and don'ts. We talked about this kind of briefly already. I can send you, Rosie, this sheet as well. I send it to all my clients. But so gift funds, without getting too off in the weeds in that, gift has to be from a next of kin. So parents, grandparents, brother, brother-in-law, first cousin is maybe. They have the same last name. You can probably sell it. After that, really can't get a gift fund. We need to document them appropriately. The easiest way, if you have someone with a gift, talk to a lender because they have different versions of what they want done. I like them to wait to deposit the funds and wire them straight to the title company. It makes it less intrusive for the gifter, the donor. We don't have to get an updated bank statement from either party. We just get a gift loan signed. Obviously, stay current on your accounts. That's all these things are self-explanatory that I'm going to go over. But the number of things we could get talking about people do is I could just have a 2-hour conversation about mistakes people have done, like buying other houses and cars when you're under contract to buy a house. Live your life as normal. Use your credit as normal. If you use a card to get flyer miles and you pay it off every month, that's fine. Just continue to do that. Don't finance anything new. We'll get into that in a second. Call me if you have questions. That's the biggest thing, is keeping the lender in the loop, because we don't know until we know, and it might be too late by then. So we need to know. I kind of tell them like, hey, if you're going to make a large purchase or something like that, let me know ahead of time. The don'ts: don't apply for new loans. Don't pay off any collection accounts or charges unless we've talked about it. Don't close any credit cards unless we've talked about it. Don't overcharge your credit cards unless you're going to pay it off in a month, every month. Do not consolidate debt. Do not dispute anything on your credit. Basically, don't do anything on your credit until we've talked. Don't change jobs unless I know about it. Marital status. This mainly applies to divorce or separation versus getting married is kind of a different scenario. Depositing funds that can't be documented. Large deposits is a large deposit is considered half of your monthly income or your paycheck. So if you're getting $2,000 a week, anything larger than $1,000 is going to be considered a large deposit. We have to source those funds, which is why the gift thing comes in there. And then don't let your driver's license expire. The number of times I've told people that their driver's license is expired or going to expire is alarmingly high. It doesn't sound like a big deal, but when they go to close, they need to provide a driver's license to sign the loan documents, and the title company will not let them sign if they have an expired ID. And that's not what you want to do at closing. Roles and responsibilities. So who takes care of what? This is you. So negotiations, communication with a loan officer on updating me. That's when you would ask me, hey, I need a pre-approval letter for 123 Smith Street at this value. Requesting documents is needed to help me. There's been a number of times that I will contact the agent like, hey, I've asked this buyer 4 times to send me their updated pay stub or their bank statement. I need a full bank statement, not a picture of the front page of their bank statement or their account summary. Can you help me? And usually it's that extra touch from you guys that scares them to get me the documents, because we're stuck sitting in the water waiting on stuff. And I want to keep you in the loop as much as me, and so it helps. Inspections, response stuff, getting the closing scheduled once we have the clear to close. I know a lot of people schedule a closing right when they get done, and as long as that's 30 days, that's fine. If it's not scheduled, then we need to chat about it, but there's scenarios for that. What I do, obviously, we've kind of all talked about it. We send out communication steps, to each buyer and both sides of the transaction agents every Friday. You get an update as far as what's going on in the transaction. We've ordered the appraisal. We're in underwriting. We're clear to close. yada, yada, yada. Both buyer and seller's agents get that information. And communicating next steps, so that's kind of it. So I realized I was running out of time, so I kind of sped up the last couple slides. This is my contact info. If you want to dive deeper in any of these things, just shoot me a text or email me. I'll send you, Rosie, some of these docs that I have put together. Yeah, what kind of questions? If you have any other questions, let me know. So appreciate it. Thanks, Rosie, for having me. Hopefully it was helpful and not too boring.
That was perfect, Larry. Thank you so much. Guys, thanks again for coming. Remember, tomorrow, Michelle and I are leading a session on technology and organization. So hope you can be there. Have a good one. Cheers.